Bueno, buenas tardes a todos. Vamos a empezar nuestra quinta.
Good afternoon. We're beginning our fifth annual conference. Thank you and congratulations to those of you who have joined us today, because what with the stock exchanges and coronavirus, COVID-19, I have to say thank you. It's wonderful to have an audience this afternoon in order to, be able to explain many issues and address the subjects that keep us busy. So, as to the logistics, we are going to distribute cards. This year, please let us know your name. Should there be too many questions and we not be able to take your question, we will be in a position to answer. We've also got other questions coming in. I'm not seeing that many persons with us in the hall, but in any case, please do let us know who you are. Well, it's a brand new decade, and we have a lot to talk about. We're going to talk about events that happen once every 20 years, but as always, let's take a look at our results. Let's see what's happened. As of the very beginning, these are last year's results. As you can see, these data are relatively obsolete because at the beginning of the year, we saw how our fund dropped by over 25%. We're going to try to explain why this happened. We're going to try to explain what it is that we believe the future holds. But before I do anything else, I'd like to ask you to travel back in time. 10 years ago, when Lehman Brothers fell, remember the Great Recession, we debated whether a system such as this one, a broken system, a system in which the stock exchange fell by over 50%, we wondered, does it make sense for central banks to rescue the economies? Some said no, some said it may generate inflation, but many spoke in favor. And I think that most of us now believe that it was well done. Central banks saved our economies, and it was a timely intervention. They did what they had to do. 10 years after, and well, perhaps the past 2 or 3 days of free fall, we've seen that unemployment is at minimum levels, shares are at maximum levels, bonds maximum, spreads minimum levels. In other words, the conditions are truly good, very good. Well, no one would have expected 10 years ago that this being the state of affair, we would need to add more kindling wood to the fire. And this is exactly what's happened. Maybe now, and after what we've seen over the past 2 days, we'll be seeing even more of the same. But until last month, 2 months ago, with the repo mechanism, we continue to see money being churned out. And this results in extreme measures. We're going to explain what these extreme measures are, but we'll see that there are great winners. That's where the money goes. The Fed, as I say, was at the printing machine. And then there's losers, those parts of the economy, those companies which money takes a longer time in arriving. And what is the result? Well, the result is the most expensive market ever, no matter where we look at it from. Here we see 8 different measures, and pretty well all of them are at that 100% historical percentile, excluding, as I say, the 2 more recent sessions of S&Ps. We see that the market now is as expensive as it's ever been before. Now, this market has been led basically by a bundle of companies that are accountable, if you will, for its organization, and these are tech companies. So what we should do now is ask ourselves, is anything different now? And I say ask this of ourselves because when the market is this expensive, usually if the market is expensive, what happens is you land flat on your back in the stock exchange. But what we're wondering is everything different now? What do we do? Google, Amazon, what do we do? Well, we've seen that there's a number of reasons that would encourage us to think that we've definitely progressed in technological terms. Central banks are doing their utmost. Major companies seem to be getting bigger all the time. The stronger seem to be getting stronger all the time. They have access to cheaper money. They have access very easily to credit. Remember, Warren Buffett took a loan and the rate was 0. In the face of criticism that says, well, the regulatory authorities won't allow for this, it's not very clear how are they going to stop these large companies who've done such a great job and who have ultimately brought us to this very expensive market. And finally, a little bit more complex perhaps, but there are those who say, well, the market wouldn't be as it is now if we were to consider that these leading companies are franchises. In other words, these are companies that are going to grow very much into the future, companies that are difficult to take down, and companies that if we adjust our accounting, which perhaps is obsolete, well, maybe not that expensive if we, as I say, adjust our accounting. Well, let's see whether this time it's different or not. Because beside this very expensive market, we have another market which basically has sunk: raw material. 3 times raw material have been really expensive and 3 times they've been really affordable over the past half century. Now, as you can see, well, last time it was 20 years ago, they're extremely affordable. So please keep this in mind: a very expensive market with very, very affordable raw material. Not only raw material, though. That's not the only thing that's cheap, that's going cheap. This chart shows us in an arbitrary manner, because value and growth are 2 different concepts and they have got to be unbundled, but we can see how over the past 35 years, well, when the slope falls, value companies, which is the companies that we invest in, perform less well than growth. And over the past 35 years, there has not been a moment in time which for so long had value underperforming as it is. So we need to think, is it going to be different this time around? Should we be leaving this market? As some customers, and very legitimately so, have recommended. They said, well, maybe you should no longer insist on what you always insist on. Maybe you should return to growth companies, the traditional ones, the ones who do a good job. Our response to that comment or question, is it different this time around, is that it's never different, really. And what do I mean when I say this? Why do I say it's never really different? Well, because if you're thinking about the future price of an asset, what really matters is its value initially. That's the key. So if we look at the more expensive companies, pretty well always, when they're very expensive, they tend to drop. And if we begin with something which is very affordable, it always goes up. This happens. Let me nuance that, of course, if it's affordable, it grows if it is good value. In other words, it has to be a company which is affordable because it's doing a good job. So my proposal to defend, if you will, what I'm saying now. I would propose a walk down memory lane, as they say. Let's see what happened in the past 6 decades. Let's see. Systematically, we see bad behavior 10 years after a price is high. Let's go to the 60s. Franchises, the nifty 50s. We'll see some slides in a couple of minutes, and you'll see what companies I'm referring to. They grew, and in '69, that was the peak. It seemed that it was impossible for them to drop, and it was a one-decision stock. In other words, it's so good that you take the decision to buy, you hold on to what you've bought, and you'll make money always. Well, it was terrible, the results in the 70s. But in the 70s, energy and gold were unstoppable, and for 10 years generated over 20% per annum. At the end of the 70s, they peaked, and in the 80s, they fell. They fell hard. They fell the hardest. Let's go to the 80s. This decade was the Japan decade, the Japanese miracle. 89 was the peak year. The Nikkei was at over twice its current value. It's been over 30 years. It peaked, it seemed to be unshatterable, and in the 90s, it shattered. In the 90s, and here we are, Fernando and I were, let's say, active. That was the TMTs. All of you remember Terra? Who thought Terra would fall? 15 euros, and it was at a given point in time at 168.5, unstoppable. But in the following decade, everything was lost. And the same can be said about other TMTs. If you have questions, we've got a chart. In the year 2000, again, there were golden boys, that's gold, energy, small companies, and we definitely took advantage of that because we invested and we made a lot of money in our past decade. And as of 2010, they also fell. 2010, and that was quantitative easing, more stable companies, the larger members of S&Ps, they grew and grew, and that's what we saw before. That's the most expensive market ever. Is someone going to crash? Well, we're not sure. We have to be prepared, and we have to think about that question. Is it going to be different this time around? However, what is now cheap, what has been hated, well, let's look back in time. What do we not like today? Well, we just saw that. We don't like raw material. We don't like... What happened here, says the speaker? Raw material. We hate value. I think that you know we've got copper, we've got uranium, we've got oil, we've got value companies in general. What do we have? Let's take a look at the portfolio. What we can say is that what we have, people really hate. It's difficult, it's frustrating over time to keep these commodities in our portfolio. But history tells us that something that is hated evolves, and after that being those years of hate, we see wonderful decades, 12 years maybe. And golden boys tend to, in those future years, not perform as well. So let's take a look now at what we have, what we call industrial. The material of the companies we look at. There's a number of companies that we like that, and we're going to see the implicit profitability, which is if you put 100 pesetas, how much of a return we get. So in terms of comparison, our metrics, free cash flow, that's divided by the sum of what it is worth and what it owes. In S&Ps, this would be approximately 2.2. This is before that 10% fall. 2.2, which compares with Freeport-McMoRan, 12.3% in one of the world's leading companies in the production of copper. Hyundai, a company which you know, they build cars, that's a 20% implicit profitability. Tenaris, a global leader, associated to the Roca family. World leader means number one, not one of the top 10. It is number one in the production of tubes for oil. We have another company, Industrial Gases, Sol Group, an Italian company. Our partner, Aldo Fumagalli, whom we've known for over 15 years, well, that is an 11.8. That's nearly 12%. Our Grupo Mexico, all of you know, our partner is Germán Larrea, and that's the person with whom we share ownership, and that's 12% implicit profitability. Eurocash. Eurocash is a regional leader in wholesale foodstuffs. That's Poland. We work there with Luis Amaral. They have more market share than the second, third, and fourth together in Poland. This is an outstanding business model, and it's an implicit profit of 11.6. Schlumberger, #1 in the world in oil services, with a customer portfolio that is the world over. They're not, well, perhaps the American portion, but they're all over. And that's 14% implicit. I think that this would be a price-earnings ratio of perhaps 6. So another well-known company, National Oilwell Varco, 12% global leader in software systems and intelligence systems, again for platforms. So as you can see, this is a bundle of companies. They're different. They all belong to the group of the hated companies. So we see that they need these commodities, they need raw material or value as solid gas, and at this point we're not thinking of them. I'm going to give the floor to Fernando. They're going to focus on the portfolio portion that we should be perhaps focusing on in greater detail today. Well, indeed, what we are going to be looking at now is the case of a small number of companies. It's just 5 companies, and they explain that drop in the international fund to 220. That's what it was until today, at least. And it's basically a concentration of companies that explain most of our drop in our international fund. We're going to explain what has happened, and we're going to see what we can expect from them. So we have platforms, 3 large, 1 which is smaller, which have suffered and which now represent 6% of our international portfolio. You know what they are. You know what these platforms are. They're huge structures. They're miracles of engineering, and they can cost $1 billion. So what truly matters here is that they are absolutely essential. These rigs are absolutely essential to produce 1/3 of the oil and gas which are used on a daily basis. They're absolutely essential. So what the companies do that we have in our portfolio is they order these rigs from the world's leading shipyards, Japan, Korea. They receive them, say, 3 years after, which is how long it takes to build a platform. And with good maintenance, they can last perhaps 40 years and sometimes even more than 40 years. To keep things very simple, what they then do is they lease it to the oil companies. So it's interesting to compare with another business, real estate. It's like floating real estate, because these are assets that are very, very valuable with a very long life, and they are profitable insofar as they are leased. But there's something special. There's tremendous degrees of volatility, much more than there is in the field of real estate. This is important, and I'll explain why it's important, because we need to understand their performance. This is a look back over 25 years. This is a special kind of a rig. This is a jackup. These are not the more common assets. They're not the more volatile. They're used in shallow waters. But we understand these are assets that have been rented out for as cheap as $40,000 a day and as expensively as $230,000 a day. That's volatility for you. That's extreme volatility. And by the way, after this recent minimum, they're beginning to recover. That's very important. So if we were to talk about the rigs that are used for super deep waters, it's very similar. The more recent maximum in the cycle was back in 2013, 2014. They were being rented out at $600,000 per day. They reached minimum $130,000, $140,000 per year a year ago, and now they're beginning to recover. And now they're at about $220,000, $230,000 per day. So as I said, this is important. This is important. We believe this is essential. We need to understand this chart. This chart is 40 years worth of history of Valaris's value. This is one of the companies we have in the portfolio. That's the white line. The yellow line is the price of leases for these rigs. And you can see it perfectly well. It really is the essence of a cyclical model. At the 80s, it was going at $27 per transaction. A couple of years after that, it drops 97%. So basically, you're lost, and it's at $0.4 per share. In a couple of years, it recovers and multiplies by 16 or 17, so it's up at $7. Again, it drops, 90% is lost. The minimum is at $1.1. Then it multiplies by 70, 10 years after, times 70. That's a lot of volatility. You can't really see it. It's very jagged, but as you can see, what is important here, it's that times 70. It seemed as if the company were going to disappear. It was worth nothing. Again, it plummets to 9. Again, another maximum, multiplying by, 10 to reach 82. And so far to date, what we see is the company now is at 1.4, 1.5, and that's another minimum, which we have seen has happened before. These violent, very frequently, very violent swaying movements. We do believe it will recover perfectly. We didn't buy it at the minimum. We have a rough cost of $8 in Valaris, but if you look back in time, you'll see how very important it is to buy not when they're at their floor level, but when they are very affordable. Our analysis is that the future is going to be very similar to the past, and that's why we think it's important to hold on to them. So we may be wrong, but we're convinced. Afterwards, if you want, do ask us, and we will be happy to go into the specifics. I understand that volatility is very uncomfortable, and actually these companies, on any given day, they're up 20% or down 20%, but we believe that withstanding that volatility is well worth our while. Now, on this slide, we're going to see a little bit more clearly how this opportunity becomes numbers. When we presented, it was at this price. Now it's at 1.5. But what is very important to keep in mind is to think about the value, the difference between price and value. And we've specified 3 different methods. One would be the steel value. That's of those different independent valuations that maritime brokers and specialized consultants, on the basis of transactions that take place in this market, that would be similar, if you will, to real estate activities in the real estate sector. So these experts who look at Valaris, net of the debt divided by the number of shares, will give a value per share of roughly $19, which is a multiple of what the current price actually is. If we see our valuation normalized, which is looking at a price which we calculate, the Valaris price would be $60 per share, which is incredible if you see what the price is. But in the past, it has been worth $80. So we believe that this is a solid alternative. And if we look at book value of the funds themselves, in other words, if we think about what accounting tells us, after having written off and after having amortized some assets ever since 2014, when the crisis was unleashed, we see that it's 47.2. So the potential is truly spectacular. So this is basically what happens in our investments in the sector. The numbers might vary a little bit, but the idea is very, very similar. This as to rigs or platforms. The second case is our investment in coal mining with Consol Energy. This is a company which now is at about 2% after dropping. Let me begin by saying that, I understand that many of you are perhaps befuddled by the fact that we're investing in coal mining. You might wonder, have we gone crazy? Well, let me allay your fears and assure you that no, we're fully aware of the fact that coal is not the energy of the future. But I think it's also very important, or we think it's very important, to avoid the headlines. Because, coal is not going to disappear overnight or anytime soon, actually. So let's take a snapshot of the current state of affairs. Not only because Consol exports 30%, it's an American producer, but they export 30%, but furthermore, because at the end of the day, the dynamics of the international market are very important when we determine, in local terms, the price of coal. So you might be surprised to hear that the global coal market has grown by 1% in terms of volume, 1% every year for 10 years. So it's not in decline. Actually, international carbon exchanges, well, that's grown actually by pretty well 3% per year in the past 10 years. And if we think about the plans that exist of closing plants in the West, of course, and if we think about opening up of new plants basically in Asia, many of them at this moment under construction, the capacity to generate coal or electricity, coal-based electricity, is going to continue growing. I'm just trying to get the idea across that even if not everything is completed as we might expect now, but if you're thinking that over the 20 coming years coal is going to disappear, I would have to say that no, this is not going to happen. So that's a global statement, and Consol is pretty well halfway up the cost curve. And as I say, last year they exported 30% of their production. In the U.S. local market, things are different. This is a market that is declining. Some years ago, there was tremendous use. There has been a plummeting. Mines have been closed. Companies have gone bankrupt. But it's interesting to see that over these years, what Consol Energy has done is grow its production, 23, 24 million tons, and now 27, 28 million tons. Why, you might ask? Well, because, as we said, Consol Energy is competitive in international terms, but in the USA, it is the company that is best managed. It is the one that generates most margins per ton for a number of reasons. It's structural reasons. It's reasons that are long-lasting. First, because the mines are very productive, and secondly, because of their location, which is very advantageous, but especially, I would say, because they have a geological legacy. Their coal is of fantastic quality, very little sulfur, but fantastic quality. 30 million BTUs per pound, which is much more than the average, much more so than Australian or Indonesian coal, which are also selling on the market. So this is the US's best coal company with the best margins per ton, 25 years reserve, super solid numbers, and an excellent managerial team. We love them because they have a fantastic corporate culture. And now they're at about $150 million valuation. It's market cap, which is actually less than what it earned just 2 years ago, back in 18, as you can see. 222. That's what it generated in free cash flow. Basically the day before yesterday. This year, the prices have suffered. They're going to earn less money. They're going to earn 84, which continues to be a healthy number. It's twice profits. And if we looked at the prices of coal, historically depressed prices at minimum levels, the company is listed, and it's 2.5 profits. So this is undervaluation.
And if that were not all, the company owners the export terminal in Baltimore, which is possibly the best dry load export facility in the U.S. It exports other types of products as well, not only coal, other commodities as well, and it could export anything that is dry bulk. And it might be worth, such a popular infrastructure might be worth $400 million. So only this asset is worth more than the whole company. In fact, the company is not discarding selling it if it's to their advantage. Or if you want to see it differently, the company would be completely free of debt and would be listed at 2 times profit even with local prices. And thirdly, I'd like to talk about Tullow Oil, which is one of our investments in the oil industry. I think it represents 1.5%. That's the way it has. And I would like to give you the historical context of this investment. It was listed at £14 per share in the year 2013-14, before the crisis in the industry. It was a great success story in exploration and production in Africa, but at the end of 2014, it had too much debt in its balance sheet. From there on, the company decides to do a capital increase at the beginning of 2017, after which is where we invested at lower prices than the previous peak in the cycle, because our average cost was £1.5 from those £14 that I mentioned earlier. So we saw a company that has very sound assets because it's a low-cost product. It produces at $30 per barrel all-inclusive, with a good balance sheet after that capital increase and great optionality for discoveries it had done before we had invested. Not in production yet, but very important assets in Uganda and Kenya, and a very interesting exploration portfolio in other countries like Namibia. We call it the perfect storm, this slide. Everything that could go wrong did. And perhaps in the Q&A, we can go into further details if you so wish. But the company started to face some production problems, temporary problems, and delays in the new projects in Uganda and Kenya. And everything was exacerbated with the fall of oil prices, which we've also seen last Friday and today, which is the most important factor. Now, the interesting thing about this case is that what we do, as always, is to go deeper into our analysis. We talked to the company several times, of course, and with experts and some of their partners in some of the fields they produce. We even met with the board of directors to give them some recommendations, which we thought were appropriate with regards to what to do regarding the capital structure. In other words, we did our analysis in order to test the theory again, but given the very new complex system and the situation of the company, where the debt that before was very comfortable now was no longer so, we decided to be cautious and not continue buying. Contrary to what is done in these cases when a company falls, if they're convinced of their value, they buy more. They double their stakes. Well, we prefer to remain cautious and not continue to invest. And this is why the weight is very small now. Now, we did not decide to sell either, because as we usually do, but even more so in this case, we looked at the different scenarios. And in a scenario where we thought that the company must do a very dilutive capital increase, it might take time to recover. And even so, in that scenario, we wanted a security margin because we would have 60 pence per share. less than what it's listed today. And if that worst scenario doesn't happen, and if the company avoids the capital increase, which would be the best base scenario, the potential is very significant with valuations of almost £2 to £3 per share, not the 4 or 5.5 pounds that we thought had at the beginning when we invested, but this does have potential. Now, we went over these cases and we saw a very important gap of price value, as we mentioned at the beginning. Thank you, Fernando. Let's see what this materializes in, more specifically. In this slide, we were saying that the market is expensive. It is the most expensive moment in history. We looked at the last 6 decades, and what is systematically expensive falls and falls a lot. And now in this very expensive market, we have an industry which is commodities, but other companies too that are very cheap. Now, we saw what this consists of. We have 10, 12 companies that we explained the return is 9 or 10 times more than Standard & Poor's. We just saw the companies that might generate more doubts. But what does this mean? Well, it's summed up in those 2 lines. The yellow line is where we are today at 82 per share. The blue line is what I think our portfolio is worth. Now, the question is, but those 242 that you show us there, to what extent haven't you made that up? Now, that's a very legitimate question. Now, it's ours. It's what we believe. It's what backs the investments in our funds. And it is in our opinion that in each one of the companies, there's more than one valuation method. We value the companies trying always to look for the worst scenario. For example, a house. You can value it capitalizing the leases or how the neighbor's house was sold, or you can value it seeing how much it costs to build it, or replacement value. In each one of our companies, we have something similar to these 3 values. And we buy when the worst one of these gives us a high potential. Now, this is not the first time that we have to make an effort in saying that something is worth more than double at what it's listed. In 2019, I remember that our settlement value was 16 and the fund was listed at 9. It was March the 9th. That must be a signal, but we believed it. And some people laughed at us when we said we were worth much more. But well, we were right. Now, we think that the value is there. And the next question is when? And people say, yes, fine, but when is the value going to be recognized?
Ejemplos, ¿no?
And we have several examples. Sometimes the value flourishes, or we can see it in 3 months. That was the case of our launch in 2015, where as soon as we launched it, we had a significant fall. The fund went to 181 liquidation value, and then a few months after, it had gone up 45%. Now, nothing new had happened between January and April of 2016. Nothing new that could explain this increase. We always want to label things. Why did it go up? Looking, as journalists do, for a headline for everything that happens. Sometimes things happen, but we can't really explain it. It was just too cheap. That's why it went up in value. And sometimes it takes 3 years. 3 years ago, we invested in gold. And that was a very controversial investment because people with their arguments, very valid arguments, were telling us that that was ridiculous, that was worth nothing. Gold, why do you invest in gold? It isn't worth anything. And we developed our argument. Besides the fact that it's a protection against the central bank, and when you invest in the most hated asset, the next 10 years are very good. Now, for 3 years, we got no return in our gold mines, and now they're starting to be profitable. Companies like Barrick Gold, which is 7% of the fund, we're going to make more than 50%. So sometimes 3 years have to go by until you see it. But it always flourishes. It always comes to the surface. Now, if you haven't made a mistake, if there isn't a catch-22 there, it's 10 or 15% right now. That's what it's been in the past 20 years. But we, apart from having a portfolio that is much cheaper than the market, we moreover believe that it's a growing portfolio. And let me show you this simple graph. We said that we have uranium, copper companies, oil, that are fundamental elements for growth, to live better, let's put it that way. And in this graph, the ones at the bottom left want to live like the ones at the top right. And for that, they need copper, they need energy, power. And there we see the size of the population, which is represented by the size of the cycles. The world is not Germany, France, Spain, the US, China. In 15 or 20 years, we will be many more people in the world, many million more. And we are in businesses that help those people that go from an income per capita of 4 or 5 euros to 8,000 or 9,000 euros of income per capita, which is when you become middle class. Our companies are going to allow them to make that transition. And they're going to make that transition. You can be certain of that, no matter what we say in the developed world. And it is difficult to have a disruption because ad valor companies, some have disappointed some investors because there was an industrial revolution. So if you think that department stores are a valuable company, well, watch out because nobody ever goes anymore to department stores. But, getting uranium cheaper than others in Canada is very difficult. And the Chinese want nuclear energy, or getting copper cheaper than Freeport or Buenaventura is very difficult. And the Chinese and the Indians are going to need copper. Oil, which is a great protagonist of the past 2 to 3 days, they're going to need oil. Later on in the Q&A, we can talk about this. Oil will be needed because it's very difficult to reduce the consumption of oil. The consumption of fossil fuels has fallen, and oil at $30, well, is not enough for them to produce it. So it's very difficult for these companies to suffer the disruption that department stores have. It's very difficult for these markets to be disrupted. So we encourage you once again to believe the blue line. We certainly believe in it. And there's proof for that. And to replace the product of when will they go up, which is a very legitimate question, but very difficult to answer. And if we were to answer this question, it would depend more on us and our forecast. So think that what is relevant is that the value always flourishes. And let me now hand over to Beltran.
Muy bien, pues yo les voy a hablar un poco de la actualidad del año 2019. Sí, como
As Alvaro was saying, 3 months or 3 years later, we see the value come to the light. And we need to help. Thank you for your support. 2019 had been a difficult year. After 8 weeks of the year 2020, we think it was a quiet year. And after what happened on Friday and Monday with oil prices, even more so, we ended the year with 1.4 billion euros under management, which is 7 or 8% less than when we started the year. The performance of our funds vis-a-vis the market did not encourage many of our investors much, but we also have good news because our investor base 17,360 investors. In 2019, 10% of those investors joined us. And from the point of view of the team, we are at one of our best moments. We have 3 new hires in 2019, and a fourth one in 2020, and we are 38 employees now. And we are one of the best moments from the point of view of the team we have at AsValor. In terms of the model, we still work in direct relationship model with our investors, with those 1,300 meetings one-on-one with our investors, sometimes with the management team and the famous AsValor coffees that I invite you to attend. These are fast but very interesting meetings where we look at depth the most important aspects of the portfolio. We repeated our summer course with Complutense University of Madrid, which was very successful. We continue with the YouTube channel. We have 235,000 visits. We have collaborated with someone who brought a book, which I recommend. It's a book that explains what we do. It's written by Nassim Nicholas Taleb. We reached an agreement with the most important network of investment clubs and universities with an international presence, Madrid Invest. And we want to collaborate for the dissemination of financial knowledge and knowledge on investments. We are members of the Yivan Group. We just published a paper that took us a lot of time and effort in research to see whether boutique companies like ours add value or not. So we are focused on the aim of disseminating knowledge of the world of finance. And I wanted to talk about coronavirus, and you will say, why am I talking about this? Well, for a very simple reason. In the past few weeks, this is something that is affecting our lives, and we have received hundreds of calls in our call centers. And I asked to convey to you what our stance is vis-a-vis coronavirus. And the message is very simple. First of all, and based on the slide that Alvaro used, if you look at 10 years, it's very difficult for the world to change so much as markets are discounting for today. And the effect of something that is unknown generates a psychological impact that immediately affects the prices of companies, but might not affect the value of companies. We come here to talk about price value, and then that short-term impact with the appearance of coronavirus, perhaps behind that there is a great opportunity. And we say this because of the experience of the past few crises. There we see the different epidemics and the immediate impact on the market, the psychological impact. The markets fell and fell sharply and fast. But after 3 or 6 months, and there you have the data, after 6 months, as an average, that effect disappeared. And what I wanted to share with you is that, yes, this is a serious case and we need to study in detail. But based on what has happened in the past, on the long term, the impact on the price evaporates, and what emerges is the value of companies. And I hope that on this occasion, this will happen again. I'm going to try to summarize in no more than 10 minutes some of the most important aspects of our activities, and also update you on some things, on some transactions and technologies. With that, we want to make your life easier when you access our webpage and you use our services. From the point of view of activity, we closed 2019 at a very important level. The growth of the web activity was excellent, with 30% more use than in 2018. We had more than 2,200,000 visits, 600,000 users of our web page. So our web is a critical channel to connect with investors and potential investors. In 2019, we managed 12,000 new transactions We answered more than 5,000 calls through the call center and the relation with investors team. And there's only one case that gave rise to a claim. Only one claim in the whole year. So you can see how robust our operational platform is that we've been working on since 2015. In terms of digitization of the asset management company, which is part of our DNA, two new things. One, the indicator that we follow, which is a percentage of additional transactions that are processed digitally. In 2019, 90% of the additional transactions were done through SMS, a digital process. That percentage the previous year was 80%, so significant growth in that regard. And that means not only cost reduction, but what is even more important for us, reducing operational risk with that very high percentage of 100% digital process. And I'd like to take advantage of this conference to announce something that we've been working on for many months. As of next Monday, as of March the 16th, the new investors can sign in through a 100% digital process. We have the two alternatives. The current one, which is where you access our web, complete the process, gets the documentation through an email, prints it, signs it, and sends it to our offices, or this new process, which is 100% digital through any terminal, iPad, cellular, mobile phone, PC, without having to print and sign any documents. In terms of the lines that we're going to be working on to achieve our strategic targets, which is to facilitate accessibility and recurrence in long-term savings, two things I'd like to mention. In 2019, we processed more than 1,000 transactions of periodic contributions to the fund. This functionality, we think, is a very good way of systematizing the investment as savings occur. And also take advantage of this conference to announce that from today onwards, you can make additional contributions with a minimum amount of 100 euros. Before it was 500 euros, and now it's 100 euros, because many of our investors asked us for more flexibility to save and invest. And therefore, the amounts linked to our fund is 5,000 euros for the initial investment, with the exception of investors that are under 23 years of age, where they only need 500 euros. And for all investors, regardless of their age, and for all funds, the additional contributions are now a minimum of 100 euros. Now, with these new things, we try to make your life easier. And with the implementation of MiFID, and of new regulatory requirements, we're making it a bit cheaper too. The implementation of MiFID that we did at the beginning of 2018, in these 2 years, we have achieved a very significant reduction of the intermediation costs. As we mentioned last year, one of the MiFID II requirements was the need to separate the two costs that are implicit in intermediation, brokerage on the one hand, and analysis or research on the other. Now, splitting these two and the better efficiency in managing these two services separately has meant that we have achieved that reduction of almost a third of intermediation costs, and that is very advantageous for all the participants and investors to the fund. And that's all from me. We're working in adding on the private area of the web new functionalities, and as it becomes operational, we will be informing you. Thank you very much, Jaime Janse Censano. Thank you very much. Thank you so much for your help. And now I'd like to hand the floor to our next speaker. Yes. The managers fund was rolled out in 2018. It was embraced by investors and number of participants, as well as the amounts managed. Thank you so much for trusting us. In 2019, we rolled out the Luxembourg version of the fund, so it's also available through that channel. The return of the fund in 2019 was 9.5%. and it's dropped significantly in the past few weeks and days. The liquidation value right now is 80 compared to the 100 euros that it was. For those who don't know it, very briefly, in this fund, what we've done is out of hundreds of managers that we looked at in different parts of the world, we picked 4 of them to invest for our fund in their best investment ideas. All of them share with AsValor the basic culture in terms of being an independent boutique owned by the employees, being a team that invests its own money in their strategies, being specialists in a type of management or management style, experienced teams who have been working on this for many years. They invest in concentrated portfolios, picking each one of the companies through a fundamental, very deep analysis on each one of them. We are fully convinced of their excellent work. At different times throughout the year, they've come to Madrid, and our investors had the chance to meet them firsthand. What does the fund invest in? If there's a common characteristic, is that in investing in things that have not gone up as much as the market had in the past few weeks. We did an exercise a few months ago where we took the portfolio of the AsValor Managers Fund and we did a simulation 5 years back to see what had happened with those companies. And we followed in the graph, the green line was what the Standard & Poor's 500 did. The brown line is the MSCI C1 and the others. One is our managers. Not so much did they not go up so much, but they had actually fallen. So we invest in companies that whose price have fallen and whose price is very cheap and therefore give us a very good security margin. But it's not only that we buy them because they are cheap. We buy them because they are at a very good moment in terms of their business development, cash flows, their financial situation is good. These are companies that in many cases are buying back their own shares in the market. And so the implicit return of the portfolio as a whole, according to the annual profit generated by the companies in the portfolio, is more than 11%. The return according to the cash flow generated by the companies in the portfolio is more than 16%. And when you buy these types of companies, you usually see corporate deals. Several companies in the portfolio in the past few months have gone through a takeover bid. Roadshow, for example, an Australian company, another one like Almacenes Éxito, which is a supermarket chain from Colombia. And 10 days ago, the Tudor Perini company, an industrial company that was received an offer, takeover bid from private equity capital with 40% premium over the listed price. In brief, good companies. How can managers find these companies? Well, the answer is going to areas in the market that very few people look at. Small companies, very tiny companies in some cases, outside that are not included in the indexes. The overlapping of the fund portfolio with the index fund is 0. These companies are not in the radar of Wall Street analysts. In some cases, with very little coverage by those analysts, and where managers therefore can find those jewels.
Y bueno, es importante con este estilo de inversión.
It's very important to have a long-term horizon for investment purposes. We've talked about this, but we're not really sure when price and value are going to converge. So, of course, we need time. Ever since we launched the fund, we've always said that this is a fund that calls for at least a 7 to 10 year timeline, as if it were private equity, where you invest your capital and you don't really worry about the ups and downs in the market. You actually use those periods of falls to enhance your position. Why 7 to 10 years? Well, because we believe that less than that, there's some elements. The market is whimsical. Some things are fashionable, other things are not fashionable. Luck, external factors, that don't have to do with the evolution of the company, but that do affect their prices. So it's fair to say that this is a period of time whereby with a great manager, with a solid investment process, we're going to achieve fantastic profits, fantastic yield. And that's, Morningstar published a report just a few months ago, and they had taken the funds that had best performed over a 15-year period, and they had calculated how long it had taken them to generate those yields. Well, only 5% of the entire 15 years. In 7 months, they had achieved those extraordinary results. In other words, at the end of the day, there are periods that are not profitable, painful, but essential if you're going to succeed in the market. I've been studying managers for 2 decades now, and all of the managers, every single manager in the world, even the world's best, the legendary, even Mr. Warren Buffett, if you look at some periods of time, they're usually for a longer period of time under rather than above. And then the manager needs to have the right kind of a personality. So when there's storms, when there's difficulties, the manager needs to be true to himself and solid. We have good examples among the managers in this fund who were already active at the end of the 1990s when the dot-com bubble, 98, 99, they lagged behind. They lagged behind because they were loyal to their investment style. From 2001, 2002, the market was plummeting 40, 50%, and their funds grew by 30, 40%. And to conclude, I would just say that there's some very interesting companies there that some managers have bought at very low prices, top-notch managers. We're looking forward to wonderful successes forward-looking. And of course, the Asvalor employees are managers themselves, and we've taken advantage of the past few days of drops in order to ensure that there's new contributions. Thank you. I think it's time now to address our conclusions, and then we can take questions. March 9, 2000 was the day when the dot-com bubble exploded. That was 20 years ago. Who knows why? But on March 9, they stopped growing and NASDAQ fell by 80%. The portfolios under management back then grew by about 50% before the recession of 2001, 2, and 3 hit us, which wiped out 50% of Standard & Poor's. These things happen. At this point in time, we're seeing extreme valuations. And at the same time, we see expensive markets, yes, but there's also a wonderful array of opportunities which we like and which we believe in and which we believe we need to take advantage of. So we're going to be loyal to ourselves. As Jean-Marie Riard said, we prefer to lose half of our customers rather than half of the money that our customers have given us for management. So we're not going to change our strategy. We are convinced that what we have committed to with your good selves is what we have to achieve. It is frustrating. It's not the first time this happens. It's been 2 or 3 times over the past 20 years. And yes, it is frustrating. A real estate bubble in Spain as of the year 2004. And then it exploded 5 years after. And there was a plummeting, the same as with the dot-coms. And then March 11 of 2009. Remember, the world came to an end. And we thought, well, it's not going to come to an end. And now it's another similar point in time. There's novelties that happen, and you think everything is going to change, but things have changed before, and we continue to achieve good results. We don't want to be unduly comfortable and just invest in those companies that everybody loves. So we're going to talk now about Africa Directo. Jose Maria Marquez, for 13 years now, has been focusing on this fund. He's usually with us, but not this time around because he is in Africa. So a little bit of information. We've invested last year 650,000 euros in projects. Over 20 projects have benefited, and here's our video. We're casting the video.
Muy buenas tardes.
Good afternoon to all. as co-investors in Asvalor, we know the world is changing. We know there's going to be more population. There's going to be more hunger for coal and oil and cars and uranium and energy. And as co-donors with Davalor, we believe that this growth should be a fair one, and we can do things better. More schools, more hospitals. All of these persons who are growing up in this world grow up well. We want to be solidary. And this is why Davalor is doing so very many things. In 2019, we have launched over 20 projects in 10 countries in Africa. We've invested 650,000 euros in different projects. I was in Kenya back in 2019, and I visited 2 Davalor schools, a wonderful secondary school with Augustinian sisters and another primary school in Turkana in northern Kenya, where we have pastors with the Evangelizing Sisters of Mary. These projects are wonderful, and they are changing the lives of people. In 2019, I was also in Zambia and Tanzania visiting secondary schools, also Davalor projects. These children are so hopeful. I loved talking with them, and I would love it if you were able to visit them and see these projects yourselves. You would be impressed if you were to see what these children, what these youth expect of their future. I'm not with you this afternoon. I like to be with you, but not this time around. I'm in Uganda and in Sudan. In Uganda, we're going to see the work being carried out with doctors in a refugee camp, 300,000 persons in northern Uganda. They have come up from southern Sudan. This is a healthcare project. I will also be visiting facilities with IKE, also funded by Davalor, a large number of wonderful projects. If you were able to see them with your own eyes, you would be so very proud. I really like to say that giving is receiving. And of course, the one who has received ought to return. Thank you very much, and Godspeed.
Si quieres comentar.
Would you like to say anything? Well, the fact of the matter is, as of our beginnings with the Davalor, all of your good selves have contributed approximately 1,600,000 euros to different projects. Time now for questions. Well, great. I'm going to try to group the questions under different headings. Heading of the performance. There's a number of questions. So when we talk about the objective value of the funds, we saw that briefly. And the question is, I'm not really concerned about these values. It's part of the game, and if not for them, it would be impossible to arbitrate between price and value. But I would like to know a little bit about why in a volatile setting, which is where you perform better, where you can achieve more from your portfolio, the potential of the portfolio we saw has shrunk by 20% instead of growing. And this person makes a reference to the fact that it's gone from 280 to 242, Agro International. And the question then finishes up by saying, you say that what you want to do is grow value. What happened? What explains the performance of this fund? You said 380? No, 280 to 242. I'm sorry, I didn't pronounce that properly. Well, the fact of the matter is this is an excellent question. And we think that value is a very serious thing indeed. We have an initial approximation to the companies. We evaluate them, but companies are living beings and things happen and competitors come to the surface and they have problems with their suppliers and the P&L varies, and what we do is we adjust. Sometimes we sacrifice a lesser potential for greater degrees of certainty. As I said before, it's not scientific, but we do devote time to this. It's not hard sciences. Some say it's an art, but the point is that you need to keep in mind everything you know and think about the objective price. So if it falls, it falls. And we have got to be honest, first of all, with ourselves, but of course with yourselves. Of course, there have been one-offs in some companies, and this has led us to decide to sacrifice potential in favor of value. So now, at this point in time, we see daily variations to the tune of 40%. In a share which is priced at 27 times more, we sell a little bit, and maybe we buy one that is worth 5 times more, but is more solid. That's what we do every day. Would you like to add anything? Yes, I think that you were absolutely right when you said that sometimes we look at a greater degree of security. Marginally speaking, switching some companies, which, are world leaders, and thinking about other opportunities, well, that might seem to be a present that the market gives us. The ones we bought more recently, Schlumberger, for instance. This is a company that less than a year ago was at $50, and we bought it for less than $30, which is, by the way, much less than what it was worth in 2016, when oil was at 27 in February. The market, in some cases, is exaggerating because we're talking here a global leader. Schlumberger is absolutely number one, and it is at a great distance from numbers 2 and 3. This is a company that we cannot forego. This is a company which is absolutely everywhere. So it doesn't have as much of a potential as Valaris, but instead of insisting on growing the price in a company that we're convinced about, and I've told you, yes, there's debt, but we need to abide by the process. We need to constrain ourselves. We don't get obsessed with the potential. We tend to think more about risk initially. So I think that in that case, for instance, if you allow me, the trade-off is a good one. Very good. Another question now, which addresses another issue that we discussed, the dematerialization of the economy. And the question says, it's not criticizing mistakes made, but it does criticize our nil management of risk. We see that we concentrate in companies such as Tullow Oil, and maybe our problem is that we don't know what we don't know. Remember that first conference? You talked about the origins of risk in our company, and we talked about that at great length. And perhaps also we don't know that growth will come from what grew before, but this person believes, and we respect him, that growth in the future or at some point will come from intangible goods. Maybe we ignore that. Well, perhaps we could talk about this interpretation. Very good. Well, thank you for that question, because I think a lot of people are thinking along these lines. It's actually 3 questions rolled up into one. When I look at that part that says we don't know what we are ignorant of, well, yes, in any investment, there's many things that you don't know, but what really matters is how material are these things that you don't know. In other words, if we invest in a company, an oil company, say, well, we don't know what's going to happen in the short term in the world of oil, but we can think that usually the demand is of 100 million per day. That's barrels. It grows at roughly 1% per year. Demand drops every 10 years. Last time around, it was the great financial crisis, Lehman Brothers. Perhaps this year, COVID-19 will be the year of another great drop, and maybe there will be no other drops until another 10 years pass. So in view of what we're expecting, population growth and fossil fuels being needed, well, even though persons might say that it's not the case, well, it's, as they say out there, it's baked in the cake. We don't know. We believe that in the West, per capita consumption will drop, but not in other parts of the world. So there's that, and then there's supply. If supply were to grow a lot, well, that would affect the price of oil. But we're seeing that supply, well, there's a good portion of supply which is shale gas, shale oil in the US, and that's not going to grow as some people expected. We have a different perception. Why? Well, because, we've analyzed information very carefully. We have visited Texas over the past 4 years. So if we take all of this into account, we reach the conclusion that oil will have to be at a given level so that average producers, not the most efficient ones, but not the least efficient ones either, will think about a profitability of between 3 and 7%. Because if that doesn't happen, well, there will be less production, and the price will grow. And that price is between $60 and $65. Now, once you've got that, it's not difficult to understand that if a company producing oil, complying with all of these preconditions, you buy at less than 8 or 9 times profits or earnings, they're going to make money 85% of the times. 100% of the times? No, 85% of the times. In the case of Tula, there's been a slight delay in production, as Fernando explained, in some of the oil fields. And let me add to what Fernando said, with a terrible, terrible communications policy. The fact is the CEO tries to cover up that drop in production, tries to cover it up with a purported discovery, which was not as good as expected. And we had not included that discovery in our numbers. And further, oil goes down from 60 to 30 in less than a year. So that company might need a capital increase. So there's a lot of things that we don't know. That's right. But this has always been the case. Now, with regards future growth being in the field of intangible goods, well, certainly, we're going to be doing a lot of things very differently. We're going to be doing things that are much more complex than the things we do now, but that will be growth, and that will be growth in the West. In terms of the number of persons, in purchasing power, the evolution there, it's in this part of the world. It's, those big bubbles, India, China, Asia, and growth there is going to stem from the fact that, they want copper at home, they want hot water at home, they want to have basic hospitals, and this is commodities intensive. So we believe that in dollar terms, growth is going to be stemming from the material, from the tangible. We could show some graphs of consumption of copper per capita or copper stocks per capita. We in the West have 100 kilos, and that part of the world has not even 5. I don't know whether there's room for growth there. As to risk management, this person seems to be equating the variation of the price with risk. We respect that, we understand that, because people who love us go about it exactly like this. But we do not agree. Risk, we do not believe, resides in volatility. The risk is in losing money. That's what's risky. And I insist that we have sat down with yourselves with a drop of 60%, and, we were convinced, and it was good. We continue to believe that it works. Warren Buffett said that the true measure of whether a portfolio is well-built and well-managed in terms of risk is what it does in a bull market. In a bearish market. These past times we've seen worse performance because that's what happens at the end of bullish cycles when everything is very expensive. Well, we leave that party, if you will. We leave early. The night continues, the party continues, and we miss out on the party. That's what's happened over the past 22 years. Now, what happens is the party is over and everyone has a hangover, and we're sitting there fresh. And it's been like that for the past years, but over the past 8 or 9 months, we've suffered, as Fernando said. Let me delve into this and explain that what happens is the oil portion has been very, very painful. It's been a 7 sigma event, which happens every 40 years because copper was good. We did well. In uranium, we're not losing too much money. In gold, we're made over 50%, pure gold. What I mean is that oil is what has hit us hard. If not, our portfolio would have performed even better when the market was dropping. But these dropping markets are going to be more and more of them. S&P has plummeted, as has happened historically, and we'll see whether the portfolio is conservative or not. We believe that conservative equates low prices. Yes, I would like to add something, just a nuance. I think that we have to acknowledge that he's right when he said we might not be familiar. We are, as the Americans say, the unknown unknowns. Well, there are unknowns in the world of investments in commodities, investments in raw materials. This is more important than in other businesses. And it's true, sometimes the things that we've decided to change or tweak, well, think about syndication. So if you have, say, a long trajectory of production, and these are standard fields, well, it's going to be perhaps more foreseeable than an industrial plant. So we've decided to diversify a little bit more than what we were diversifying a couple of years back. Different companies, and at the end of the day, different fields. But ultimately, when we talk about dematerialization, no, we don't agree at all. And growth of intangibles, anything that has to do with software, technology, and so on, we are, it's absolutely record-breaking, the consumption of raw materials, and it happens one year after the next, perhaps with the exception of the past few months because of COVID-19. But definitely, the evidence backs this statement. And actually, in a large portion of the world, we are witness to a speeding up of consumption. India, for instance, this is a country that is at roughly $2,000 per capita. They have 30 vehicles for every 1,000. In the U.S., you have 950 vehicles per 1,000. Spain has 650 vehicles per every 1,000 inhabitants. So India is going to gobble up the raw materials. When we talk about per capitas, India is a very good example, the best example, because it is heavily, densely populated, but it's au contraire. And actually, it's what I saw something, I wasn't aware of it, and it's very interesting. Despite the fact that the oil industry exists in 1860, 50% of consumption of oil is something that has happened over the past 20 years. And, by the way, the official centers, the think tanks that we know over the past 12 years have always been wrong when they talked about their estimates for growth, except the year 2009. Now, I wonder why. This was immediately after the great financial crisis. So we tend actually to underestimate the hunger there is to consume these materials, these raw materials. A very specific question, very concrete. We're looking for a brief answer. You talked about a profitability of 15% per annum. Are you sure that this is going to happen? And what is your timeline? Well, we never assure. We said that that was our historical average, and there was no reason for this result not be generated again. Some time has passed. We tend to look at things from the last maximum period onwards. It's been 3 years, and we believe that our portfolio has the potential to achieve that level of profits. All right, now we're going to talk about something else. Let's talk now about companies. Let's talk about sectors. With a free cash flow, the one that you've seen, which is so very attractive in your portfolio, those slides that we saw, 12%. What are companies doing with that cash? That's a great question. The fact is, most of them are buying back shares, others are shrinking debt. What we think is more important is that this process to invest be a healthy one. And we would need to have as co-investors owners. Not all of the portfolio, unfortunately, can have an owner at the head of it because in commodities, we're talking about copper mines and so on. There's not one single owner. But in more than half of the portfolio, we have people at the head of the company whose money is in it, as is ours. And, there's meritocracy, the three alternatives. If they don't have very many ideas, well, dividend. If the share price is sufficiently affordable, buy back or invest in growth projects. Yes, actually, what happens is we're looking at these prices, and recently we've seen that we're facing companies that have earnings per dividend that we hadn't really seen in the past. Maybe this is a very special example because this is very cyclical and it's very affordable. But this year, Euronav, without thinking about freight being as robust as they were at the end of last year before COVID-19, but the profitability is as expected, 14% roughly. A few companies without debt are actually taking advantage to buy debt at a discount. So that's a very interesting way of creating value for shareholders. That would be buying debt at much less than nominal, which cannot happen if you have bank, but if it's capital markets, then you can. Buying back shares, so treasury stock, and that's how they make use of cash.
Yes, can we see the slide of price value? Meanwhile, let me ask the following question. The question says, how much would the portfolio be worth if the oil price goes at 30, although it's very unlikely? But this happened today. If the price were $30 and stayed there, I guess that's what they mean, because the value of a company is the present value of future flows. So at $30 per barrel, what would happen? Well, the 12 million barrels a day of the American industry would all lose money. Number two, Saudi Arabia would have a deficit at 70, let's see, at 30, 100 billion a year deficit. Saudi Arabia has already promised things to their citizens. Russia would suffer very seriously because oil is a very important part of its economy, the most important part of its economy. So the probability for oil prices to fall to $30 and stay there for 5 years is zero, in my opinion, which I share. American shale has added 9.5 million barrels a day in the past few years, which is how much crude oil production has grown. And only the best companies in the past few years, with their learning curve, that taken to the extreme, they started to get returns on invested capital that were very modest, with at $60 or $70. So at $30, world production would be unsustainable. So we can actually discard that assumption. When we talk about zero probability, we're very careful before we say this, always in a capitalist environment, okay? When we went to Texas, the question we ask every year is if in an attempt of whatever, could the industry be nationalized, the gas industry. They laughed at us when we asked this question, and they explained it, and it will never happen. But if the economic calculation is altered because Americans print money to subsidize American oil and they lose and lose and lose for many years, it wouldn't be zero. It would be very low, but even so, not enough, just to qualify what we're talking about. Okay, we go into the part on oil. Lots of questions on oil. Questions on oil. Slower, please. Okay. What's happened with oil? Don't answer that yet, please. Another one said, because there's another one linked to this previous one, we're seeing a bearish market for oil because this is a war between Saudi Arabia and Russia and fracking and shale in the U.S. Now, how does this affect the offshore drillers, and how would it affect Tulip? And there's another question exactly the same. Well, the war between Russia and Saudi Arabia 48 hours ago was an agreement to cut back on production. Yes, there might be a war, okay, and Putin might be supporting factions that Saudi Arabians don't like. And this, so it might be a war forever, but we'll see, because the important thing is for us, what does a person in charge want, and when does he want it? That's not that clear yet. Oil, cheap oil prices. Well, the market does the following reasoning. They are going to be fighting, and when any industry is not going well, I want to take away market share from my neighbor. I sell oranges, he sells oranges. When things go wrong, I try to earn more market share from him. That's what's happening with crude oil. But that has consequences that go beyond the fact that on the short term you gain market share. It has consequences. You're taking others out of the market. So what happens? Maybe you really made American oil suffer, and then you need offshore drillers. And just to give you an idea how this works, 30 million would be in OPEC, another 12, 14 million in the U.S., offshore 27. So if oil prices continue to be low for some time, first of all, it affects offshore drillers. Does it affect them forever? Well, it's not that clear to me, because if shale dies, and at $30 it would, unless it's nationalized, then offshore drillers are necessary. I don't know what you think about this, Fernando. Yes, I agree. Think that before crude oil prices fell on Friday and Monday, but mainly because of the coronavirus, the prices of shale oil, American shale oil, was falling at $60 per barrel. So the rate of growth of shale was already questioned. So this exacerbates it tremendously. The production of shale, they call short cycle production. It's non-conventional. Non-conventional because you drill, you recover a lot of the well the first year, but then it declines very fast. You need to continue to invest a lot of money just to stand still. It's very elastic to crude oil prices, as happened in 86. The market is balanced. In other words, when prices are at levels they are today, the supply is adjusted, not immediately, but gradually. And since American shale exists as a very important factor, it happens faster because shale is very agile because of how it works. The investor was also asking about Tulip. We didn't talk about the ink tap in Tolo. In Tolo, the impact is greater, and for a reason. Just as offshore drillers have debt maturities in 4 or 5 years, so we have 4 or 5 years for prices to go up again, and they don't have too many covenants that can worry them. Tulip has a debt maturity in 1.5 years. So if crude oil prices remain low for a year, and that is possible, then Tulip would have to either forced to sell the assets in Kenya or Uganda, or do a capital increase, and it would be very dilutive. We think the capital increase would be at zero. Once they did that, they would gain time, and with crude oil prices as 60, 65, instead of at a value of 180, it would be 0.60 more or less. And the next question is whether we would increase our stake at Tullow or sell. We as managers have to have some limits, set limits for ourselves that we need to impose on ourselves. Energy are simple systems. So you have an oil field, you have production cost, everything is expected. Oil prices can fall or rise, but it's very Gaussian. It's a normal distribution, if you will. Nevertheless, when a company falls so much in the stock exchange as Tullow did when they announced that their oil in Guyana was not going to be commercial, and the CEO quit, or resigns, there is an interaction with other elements. The board becomes defensive. The company has managed to avoid lawsuits and bankruptcy. When that changes, investment errors are very easy to make. And in Tullow, this is one of the questions where, unfortunately, there is no owner. So we thought that increasing our stake in Tullow, after the fall of value was proposition, well, we talked about it. It was a very clear position. But you go from being in the hands of a company that had a CEO who has been there for many years, who was trained by the founder, who was a businessman, a well-known businessman and not the market. Well, after all that, we thought that the company had changed. And yes, new elements come up that interact between themselves, which means that you cannot predict the outcome. And if we say that there's no owner that is watching over things, it was very difficult for us, therefore, to increase our stake. Very good question, though. Yes, still all about oil and gas. Why do we think that in the oil and gas industry, the future is going to be like the past? There are analysts for years now who believe that there's a new order because of shale and a decarbonization, electrification of the global economy. What is our opinion on the future of this sector? Yes, we don't disagree with that. And even so, we think that the investment is worthwhile. Yes, there is a revolution of shale oil. Otherwise, we would have 10 million less barrels in production, so we would be needing more crude oil. The estimate is that it will continue to grow at the current rate. That is was a consensus among the most optimistic people in shale. We don't think the industry must be imploded, and we would be very seriously needing oil. And we're aware that electric cars are here to stay, that they're going to grow, expectations are going to grow. But when you see the most optimistic estimates in terms of the energy transition happening faster, even so, the impact is that crude oil will continue to grow. And that's why it's growing at 1%. Otherwise, it would grow 2 or 3%. It will continue to grow for about 10 years, and then it will reach a plateau, and it will start to fall. But in those scenarios, I've seen estimates based on electric cars of oil consumption in 2040 of 82 million barrels a day. 82 million barrels a day is what was consumed in 2008, so we're not thinking it's going to disappear. And gas is a commodity that is growing every year 5-6% because it's an energy transition gas, and for that you need to invest a great deal. I'm exaggerating, but they've only invested in shale oil, which is not giving a good return, and it's starting to slow down. So we don't need at all for shale oil to cease to exist or to fall, or that they shouldn't continue to foster electric cars. Not at all. We don't need that. If they cease to invest in the industry because there was a crisis, and now the market, we think, is going to need recovering those investments, even if it's just to meet demand. Just to add something to that, the consensus, market consensus, based on the share prices of shale companies. All of them are listed now at minimum prices, but even before these 3 or 4 days, they were at minimum levels, falling by 50, 60% from their peak level. So the market is saying there isn't so much evolution of shale oil. Companies are not profitable. We'll see whether the majors come, the large companies like Chevron, Exxon, and make investments. We'll see if they make those investments. And if they do, and concentrate the world of shale, which is very much fragmented, this is why it's so difficult to nationalize, because it's so fragmented, then we'll see. But it looks like right now the return threshold to get a 10% TIR, they need up, $65 to $75. So they talk about that revolution, but I don't see it. Neither does the market. So our opinion does not differ from that of the market. Last year, in fact, something very important happened in shale oil. That is the first time where average productivity per field, and it has improved a great deal because it's non-conventional crude. It's a new technology to extract hydrocarbons, and they're constantly improving. But despite all these efforts, despite the fact that they're increasing even more, the natural length of the drilling and the intensity of the explosions and the amount of material that they use, sands and other things, despite that, for the first time in the history of shale, productivity has fallen. So even if it's just from the geological point of view, and to that we would need to add that it's very difficult to access capital. Only because of geological problems, it's already slowing down quite a lot. Another question where we're asked to give us a score from 1 to 10. Quality of portfolio. 1 is the lowest and 10 the highest. How would you rate it? Well, quality of the portfolio with regards to return on employed capital of the businesses is lower than what it's been historically, because we are in the most expensive market in history. Nevertheless, the important thing is not the quality. And please, let's see this slide. Slide 60, no, not 61, 54, slide number 54. Can we see it on screen, please? What do we mean when we talk about quality? Now, these companies in 73, 74 were considered the best in the world, the Nifty 50, the one decision stock. The world thought they couldn't fail, and they got it right. There you have McDonald's, Sony, Pepsi Cola, and look at how quality fell. 90, 80, 70, 60, 60, 50. That was in 73 and 74. But the quality in 2000, 2002, we have McDonald's, Disney, no less, Apple, Intel, companies that continue to be cash flow generating machines. What happened with quality? McDonald's fell 75%. Apple, I guess they had a great future, as was proven later, fell 8 to 81. This is quality. But once again, the same thing happened in 2007. The highest quality companies, Apple, it fell 61, Google fell 61, Merck 66, Microsoft 50. So quality, although expensive, it wasn't worth much. It's not enough. We looked at 3 periods where the best companies in the world lost almost 2/3 of their value, sometimes even more, and that's happened 3 times. So just to focus on the question, to put quality into context, quality is not the most relevant aspect. Of course, when you can choose, as in 2003, we did put our stakes on quality, and in 2008, where we had a takeover bid. It freed up 20% of our capital, and we focused on the quality, like Rachel and, well, these companies, because there was an option there to do it. But now there's no option. And the quality part that we like from our portfolio is copper production cannot be replaced by anything else. And nuclear energy will continue to be needed, and uranium will still be necessary. When you have a uranium mine, that is an asset that cannot be replaced. And that's why it's high quality, because it cannot be duplicated or replaced. Now, I'm going to, after saying that, now let me answer. The quality measured by the return on capital, there are businesses where you invest 100 pesetas and you take away 90. Elevator company. Once you have a good density with the maintenance that you charge every month, it has 100%. Well, we don't have that, yes. The average ROCE is 13 to 14%, more or less. Why? Because we buy from the low-cost producer based on a commodity price, with which the best producer is making 10, 14%. So it's not the greatest quality, but it is the best price right now, and they cannot be replaced. What about the potential of the portfolio from 1 to 10? The potential with regards to its historical average is the second strongest, only after March 2019, which was after one of the second most important falls after 1939. The very attractive potential. How attractive is it relative to other industries? 10, I would say. We've said it, the dispersion in valuation. What do we mean by that? What companies, most expensive companies, are listed at, and the difference with the lowest companies is like with the bubble.com. It's the same levels of difference between the most expensive and the cheapest. The difference between, well, remember what happened with the valuations of the companies and how some businesses were left behind. We're at that level. But unlike those assets, what about the 10-year American bond, 0.50, 30-year bond, I think it's at 1. Another possible investment alternative, real estate, it depends on the country, of course. These are the first symptoms of inflation. Related to others, I think it's the most attractive one. And the risk of the portfolio, how would you score it? Well, for whom volatility equals risk, this has not been easy. But for many, volatility is not risk. We have the feeling that our portfolio, all the bad things are already factored in the price. Of course, it can always fall 10% more. So it's like a boat that's gone through a storm. Their sails are broken, but it continues to make progress ahead. And the rest of the market is not making progress. And let me give you an example. A company like Tesla in 3 days goes from 100 billion market cap to 160 billion. The week where they announced they're going to do a capital increase, when they said they would not do a capital increase, a bad news can generate 2-digit increases, and one of the best gold mines in the world at Nico, with which we've been making money, we have no problem with it. But it announces earnings where instead of growing production at X rate, it grows less and it falls 50%. That's a signal of the market that it has lenses to see certain companies and different lenses to look at other companies. And that, unfortunately, does not change from one day to the next. It changes one day, March the 9th, 2009. It changed, but we don't know what that day is going to be. And it can last a bit longer. But our companies, we've gone through that risk already. I haven't seen the listings today, But Javier told me that Lumberger was falling 25.30 and Friday 14 after having fallen 2/3. A company that is at 100 falls to 40 and then falls another 50%. That sounds to me like, I mean, the end of the tunnel. Get me out of the oil industry any way you can. And everyone is asking this. Can we see graph 59, slide 59? Maybe this can help this investor who's asking this question. In March 2000, look at where technology was divided by energy. And back then, there were lots of conjectures. When the line goes up, oil is cheap, technology expensive. Today, technology, once again, is much more expensive than oil. And the Standard & Poor's index has a weighing of both industries that really is striking. The energy sector has the lowest weighing in the Standard & Poor's of its history. And can we see graph number? The weight of the energy industry in the Standard & Poor's index goes up and down. We shouldn't think that it falls and stays there because there's a new paradigm. Read Black&Smith's book, who describes how oil is so present in our lives. You can't even imagine. In our clothing, in our food. It's in wind turbines, too, where you need to drill a hole to make a hole, then you need steel, then you need a steel tower, you need oil and fossil fuels for that. It's in the plastic of the blades and the lubricant. Oil is everywhere. And in 30 years, we've gone down 3%, the total primary energy. So it's cyclical, and perhaps everything is ready for that to happen. Perhaps this is a time where this will happen because American gas is affected by the Arabs and the Russians. Perhaps there will be a demand for oil and there will be no supply for it. Because in the 70s, when oil prices rose so much, there was a lot of idle capacity. That doesn't happen today. Saudi Arabia, I don't know the exact number. They have 2 million barrels a day. Idle, they could go to 13, 14 tops. 14 they say. So if there's a demand, a significant demand after coronavirus, which we think will happen, agencies have overvalued this. Perhaps everything's ready for the return of that graph to the previous level. And we will take advantage of it, of course. Not all of it, but we think 60-65 is a necessary level for companies to do the least they can do. Why do we think at such long cycles? Because on the long term, well, who's going to be there anymore? And we won't be needing the same commodities that we need today. But we invest in commodities and we stay there. So where is the work of the 12 hours? Where are our 12 hours of work if we stay with commodities? Well, it's a legitimate question. When you have negative returns, it's normal that investors should challenge what we do. But on the long term, things have come out well for us. I know that on the long term, we'll all be dead. This is what they told me in 1999, the people who loved me the most, people who, speak their mind to you. In 2016, it was 3 months, and they also laughed at us back then. And with commodities now, I understand that they say this. And I respect the question because I know investors are suffering, but the long term is not forever. We saw the presentation, the graph. Commodities turn into the darlings of the party where everyone wants to be in. In fact, I remember that in a similar context, from 69 to 82, they went up 22% a year. Every year, 22% up. calculate how much that is over so many years. And the American market, it stayed at the same level during those 12 years. So on the long term, I'm not thinking about 10 years from now on, because the question is the other way around, in my opinion. What is cheap right now that you can, which you can sleep comfortably, sleep well at night? There are very few where there is no disruption risk. Fernando, I think you are of the same opinion. With that, we prefer to be on the side of history, where we invest on what nobody wants because systematically it's the best. I would dare do a prediction. In the next decade, the best asset will be oil, I think. How to sleep at night? There's a question about that. I wanted to insist, perhaps we're being repetitive, but the fact that the world has changed and that commodities won't be necessary anymore is challenging the data. It's a narrative that we're constantly following the press, the investors, but then the data is what it is. I can tell you, for example, the use of refined copper per capita on slide 73. Maybe you'd like to say something about that slide. This is a very good slide. Not only does it show that refined copper has been growing 3% for years, not only is it growing with the growth of the population, but in fact, except for very specific periods that have to do when there was the implosion, for example, of the Soviet bloc, and on top of that, at the same time, the Japanese bubble bursts, both very important consumers of metals, where we see slight falls and then a slowdown in per capita consumption. Consumption of copper grows because the population grows, and per capita consumption continues to grow. So we're more copper intensive, at least in the world. It doesn't happen in all countries. It depends on their level of industrialization. Show us 72, please, and continue with your argument. There you have it. Yes, the stock of copper per capita. Some countries don't exist. India has a per capita consumption of copper that was negligible. Per capita, it's, well, negligible. And very different to China, and not at the same pace. But in terms of per capita consumption, with the same GDP per capita equivalent, it was at the same level as China. China is more metal intensive as Korea and Japan compared to the US and other powers. But the growth is very clear and the trend is very sound. And this population is consuming more commodities. And to that, we must add that if we want to electrify the world, renewable energies and electric cars are much more copper intensive than their conventional equivalents, which is the internal combustion car and thermal energy with combined cycles or coal plants.
And the ratios are between 4 and 5 times per unit megawatt in the generation of energy or horsepower in a car. So this is just by way of an example, copper. Fracking here, this is interesting. This is an important issue. I would like to see slide number 78. Consensus. We're not, making anybody's life complicated, and we're not working 12 to 14 hours anymore. We're working a little bit less. But these are the investments in infrastructures forecast between 2016 and 2030. Look at that. In China, in the US, in Canada, by the way, they're lagging a little bit behind, Western Europe, Asia. It is a multiple of what's been happening so far. And all of these infrastructures are very intensive in energy and in fuel and in steel and in copper. So it's actually easier, or let's see, it's less risky to forecast that the world is going to continue to build infrastructures so that people continue to be in or accede to the middle class, and not to determine whether Amazon is going to grow by 35% for 6 or 7 years, a rate which, by the way, is necessary. And by the way, we saw that all companies collapse when they're, too expensive. So we don't need to really close our eyes and believe what we're being told. No, I know that, we're put to the test and we have to prove what we defend, and not everyone agrees with us. But what we are broaching to our co-investors is, in a world where everything is expensive, bonds are worth zero, and inflation, and, if there's questions, we can go into it. If I were a Martian, I would say, well, commodities were very expensive because in this world around the corner, inflation in financial assets is going to evolve into inflation in something else. No, they're at the absolute minimum levels. Well, we think it's an opportunity. And, could it be that simple? Well, everybody thinks it's simple and agrees that it's simple, but what's difficult is to hold on, because many people didn't know, but a lot of people knew that there was a real estate bubble, and, they didn't do anything. They didn't sell their home. Who didn't know that Terra and TPI were part of a dot-com bubble? Everybody knew. But who was there selling those shares and buying other shares that perhaps fell from 43 and then to 20-something and then to 16, 35 in the space of a month and a half? When I bought CAF, everybody would say, oh, sure, there's going to be a huge plan for infrastructures in Spain, but I'm holding on to my Terras because they're, more and more expensive. People were not saying, we know how much CAF is worth. No. What people were doing is they were aware of that, but what is difficult is to have the willpower to hold on until the right moment. And I understand it's difficult. I understand it really, because every day the people who love us tell us, remind us what's happening with this, what's happening with that. But this is what we believe we have contributed over the past 22 years, and this is what we believe we have to continue to contribute with. Yes, let me add something here, because something, very important. Not that we fell in love with commodities. No, we like their price. We like their price. And by the way, our analyses and our valuations in the case of copper, $7 per ton. It costs a different amount at different points in time. We're not thinking that copper is going to do something that it has not done in the past. If copper rockets up to 10,000, well, imagine where we're going to be. We know that you have an answer. This is the upcoming question. If prices go back to levels of 2010, what happens? Well, Flipware is at 9 and it was at 60. We didn't contemplate it at 60, but it had that price. But not at, $10,000 per ton copper. That's by way of an example. But, as I said, we look at balanced prices, and we don't think that crude will be at $100-something per barrel. It was at 150 in 2008, by the way. No, I think that perhaps what this customer is asking is, if prices were prices of 2010, what would the objective value be? Well, the thing is, that question, we could say it would probably be 400, but that really wouldn't be true, because we're not going to hold on to that beyond the levels that we can expect be reasonable of a commodity. So copper is at 6,800, and then it jumps up to 8,500. Well, that's not for us. We love our wives. We don't love raw material. We don't love commodities, it seems to me. So, all right, so let's go to a different field. What is our interpretation of the automobile sector, the future impact of leading tendencies such as electrification, self-driving vehicles, connectivity, mobility, etc. And then another follow-up question, the weight of Hyundai in the portfolios and your investments. Well, as to automobiles, there's a number of challenges there by way of major investments, but, they've fallen to a level where they might actually be interesting. And Hyundai specifically, well, we think that the industrial portion of the company has more cash than what it's worth in the stock exchange. So that's why we took that decision. Very good. Your opinion regarding the financial sector, and how different is insurance? So what about Warren Buffett? Well, let me just, you have a mountain of questions there, so we don't have anything from the financial sector in our portfolio. And yes, insurance is different. Some have a leverage of 25-1 in the financial, but insurance is more 11-1. But insurances, that there's disruptions in that sector too, potential disruptions. At this point in time, a network of dealers, that used to be a barrier, but now you've got Amazon selling online, so that's a game changer. What I'm saying is they're not in the portfolio, and so far we believe there's better alternatives. And an interesting question about commodities from the social media. Do you believe that fossil fuel companies may become the new tobacco companies? The new tobacco companies, how? Maybe this is a double-pronged question. Tobacco, the tobacco companies really did a great job after, being hated by the market. Remember all that litigation, class action suits, and so on. That happens in the States. Class action suits against the tobacco companies, I repeat. So, attacking a product which obviously was problematic. But these companies, at the end of the day, well, they had their multiples, and they proved that they were able to grow, not volumes, but price, at a rate which proved the market to be excessively pessimistic. It was one of the sectors that was among the best, listed companies-wise for years. You said before, what was it? What was from 1970 to 1999 or 2003? I can't remember, but that included the underperformance because they recovered everything at the end. I think that this example actually is interesting because it tells us that when the market determines a narrative, it's like a shortcut, Oh, don't touch the tobacco companies. Well, you know what? Sometimes you have to analyze that narrative and you've got to say, well, maybe it's a source of opportunity. Not necessarily, but it may be. I think that this customer poses a question, but with a certain angle. Indeed, coal, for instance, if it were to be hated and left on the sidelines, it might suffer. But the question maybe has to do with the following. The price of consult doesn't make any sense. It's per two. But in January, BlackRock said that it was no longer going to be actively investing in coal. Now, a fund such as BlackRock, when you have passive management and 70% flow and half stock, and BlackRock and Vanguard is among the leaders. If such a giant says, I'm leaving coal, what happened was it fell off of someone's list and the share price fell by 70%. It's the same company as it was 4 months ago. And this, of course, has an impact because persons with a different list have participated in the game. And as soon as time passes and the company generates the kind of cash flow we hope it generates, and we'll be seeing somebody buying back 30% of the debt or 30% of the shares, should the share price not increase. But in fact, you fall off someone's list, the price is chastised. We cannot buy anymore because we're at the limit with Consum. But this is a temporary thing. Just as financing. Nobody wants to finance coal. Well, maybe not in the Western world, but the Chinese do, and they're very present on the international stage. But yes, indeed, in the short term, it may have a technical impact. In other words, somebody may perhaps offer the shares at whatever price, any price. We believe the right thing is to be in front of that person buying. You said something that was very interesting because, yes, indeed, sometimes we're told, no, at the end of the day, if everybody agrees that coal is not to be financed, well, maybe you shouldn't even have the companies themselves, maybe they're not forbidden to do so in regulatory terms. The economy itself will marginalize them. So maybe that'll spell the end of that business. And that is sort of focusing on what happens in one part of the world. This is what we read often in the media. And yes, there are some international entities that have said they're no longer funding coal. So European banks, very important European banks. And just this morning, we read that an Australian company has, in fact, successfully reached agreements with Chinese and Japanese banks. And this is a coal outfit, so we don't all think the same. Okay, we talked about China. Let's talk macro now. The growth in the price of commodities in the past decade coincides with a huge investment undertaken by China. It seems that China is not growing that much investments-wise. Could we not expect perhaps a flatter market with regards to the hunger for commodities? We showed a slide looking at the infrastructures between 2016 and 2030, the kind of investments in infrastructures. 10 hospitals were built in China over a 3-week period, because of COVID-19. There's the Chinese with their policies, and I think in general it's a mistake to think that. Yes, there was a super cycle of raw materials, a Chinese super cycle, and that resulted in a huge supply, and it was a surplus of supply in view of future demands, and there was a deflation. And now we see that there's issues with supply because legislation on copper and so on is shrinking. It's more expensive to produce, and environmental regulations are increasingly strict. So the average price of every one of the commodities is growing. So something interesting may happen. Supply facing greater difficulties in producing for cheap and growing demand. Actually, I think that we've got to insist on this. The key to these businesses always in the midterm is, the key is the supply. On slide number 80, we see that it's difficult to read the data, but let me explain this to you. The upper portion is the demand. As of what year? From 1900 to 2017, over a period of 120 years, 120 years of tendency. We see it's a very systematic line. And that little circle up there is China. So yes, there was an acceleration, but it is not as special as might seem. We're talking about a long-term historical context. But on the bottom, we see the expression of productivity of mining. In those same years, from 1910 to 2017, in other words, the number of tons per worker in the mining sector throughout that entire period of time, and we see how, in fact, there's a flattening as of 2000. Why? Well, because this sector, like so many others, has undergone innovation. So at the beginning of the 20th century, electrification. And between the 80s and the 90s, the immense increase in the scale of the equipment used. Everyone now knows the huge Caterpillar trucks that carry these huge amounts of material, which makes mining some fields much more profitable than it used to be back in the day. So it's actually this flattening of productivity. Now, we don't have the possibility of growing productivity in the mining sector that will allow supply side to grow. Perhaps growing demand will be slower in the future than it has been over the past 15 years when China accelerated activities. That may be. And actually, as we know, the price of copper is going to be very, very important. I think that if all of the projects underway in construction and planned constructions calling for copper in the world were to be successful, all of them, and this has never happened, supply would grow by 2%. 2%, when the long-term growth in demand has been 3%. I think that this is very telling. More questions now. Central banks. What is the future of value? Are we not tackling central banks? This is an excellent question because doubtless central banks have many resources available to them to slow down that which is inevitable and cannot be stopped. Without going into the specifics, because it might be boring perhaps for some of you, but we believe that inflation has already happened. Inflation as an increase in monetary terms, not the mass itself, multiplied by 5. Cantillon, the economist, explained that that newly minted money is not neutral. In other words, it does not go everywhere at the same time. It is the non-neutrality of money. So where has the money gone? Money that was newly minted, well, it's gone to the bonds market. It has reduced the financial cost of states. What is a symptom of inflation? Well, if you want to retire in 20 years' time, you need to have a lot more money today if you want to avoid risk. That's the first symptom of inflation. If I want to retire in 10 or 15 years, I'm going to be retired, and how much do I need to have 100,000 years a year? Well, a lot more money than I have now. That's the first symptom. And secondly, well, once the bonds are negative, well, people go to that which is more similar to bonds, and that's stable investments. And the curve tells us that this is the highest point, stable companies, growing companies. And then it's, water that drips down the sides of the umbrella. We begin to see more and more speculation. Look at NASDAQ. NASDAQ has performed very well. And also the real estate market. And slowly, it trickles down to other parts of the economy. If newly minted money has allowed for the possibility of funding states at a cheaper rate, well, what are the goods and services that the state needs? Education and healthcare. That's, the two most important spending elements. Well, in the U.S., there's major inflation levels. The average capacity of a worker, price per hour to buy a share, a Dow Jones selection. I saw this recently, and it's 3 times less than what you could buy 20 years ago. So, inflation has appeared. It is creeping, and it has not as yet hit real assets. But let's give it a little bit of time. Is it a fight? Are we tackling central banks? Yes, we are, because central banks are going to do their utmost to ensure that this is avoided. Because as soon as inflation reaches John and Jane Doe, we know what's going to happen. A policy of minimum wages and high prices. And we know that what the end result is of that. So real assets will have to think about that. So yes, we are taking on central banks, quote unquote taking on. But central banks cannot control everything. Mises has solved that. More or less time will be necessary. Yes, we're very wealthy economies with very high per capita incomes. It takes people longer to take to the streets because, 25,000, 30,000 euros, that, is money to spend. But we've seen, the Gilets jaunes, we've seen that there's people out there who are not happy, and we see that things are more and more expensive. So that 1.8 inflation level, I think that might be the inflation of, somebody who's retired, who's paid off their mortgage, yes, ask the Spanish farming sector, right? All right, let's talk about ESG. 2 questions. Is this not important, the fact that there's no demand of assets that do not comply with ESG criterion? And the cost of capital apparently growing for polluters, should that not affect the profitability of the businesses that we invest in? This is a great question. Doubtless, now ESG is parameter number one for many investors. There's many investors the world over. Some of them have lists, and if you don't make good on the criteria in the list, you're not going to be a candidate. Well, we're not going to deny that BlackRock has said they're not investing in coal, and this has affected share prices for Consol. Is that value destruction or not? Well, we have a different idea, a different opinion. We believe that it might be a window of opportunity if some people aren't buying whatever stock, and that allows us to take advantage of that window. We could talk about ESG. Up to what point are we going to, I don't know. For us, ESG is, well, we've been ESGing for many, many years now. We believe that for companies to make more money, with that objective in mind, which is the objective which we believe is paramount, well, they have to pay their employees well. And we recommend that they do that when they ask. The companies that we're active with right now in the mining sector, we think it's great to invest a little bit more to build schools and hospitals in those parts of the world where we are, in faraway parts of Africa. We think it's good that the environment be protected, but not because it's our criteria. No, it's good because of litigation. You avoid litigation. You avoid, losing money. So you're investing 30,000 and an asset costs millions. Well, that makes sense. Actually, one of our major investments, I remember we had a conversation with Roque Benavides, and he told us that a mine which is not too profitable, Julcani, the analyst told him that if it wasn't going to generate EBITDA, he had to close it. And he said, well, Alvaro, analysts are telling me this. What do you think? I was with him alone that day. What do you think? He asked. And I told him, well, we're in Peru, and we've been in Peru ever since 1956. Foreign companies, when they go to Peru, they call us, Roque. So I think that, I don't know, maybe $1 million EBITDA, plus or minus. I think, we can survive because that's goodwill that we want to defend. And he said, well, that's how we think too. That's ESG. Do things right. Pay your employees fair wages. Leave the environment as you found it or better. But do it not because you want to be good. No, do it because it's good for the business. Because being good is relative. I don't know, is whiskey ESG? Are video games ESG? I mean, you see kids who are sitting on a couch all day long. What I do know is someone out there is trying to tell me what's good and what's bad. And I think that, good for, we all have the right to our opinion. So, fine. But as investors, we cannot do that. If somebody says, I'm not investing because that's not on my list, we'll be there taking a look and seeing whether this is an opportunity for us. And always, we say, make sure that you clean up after yourself. Pay your employees fair wages. Be careful how you invest. The money's good. And that's our view. Yes, I would like to say that we've studied this, we've talked about this, and we think that it's very complex of an issue. It's a relatively new phenomenon. And my opinion is that, sometimes people just, very merrily jump into this because it's good for business, apparently. But, let's see what happens with ESG criteria over time. Because, as I say, we're at the beginning stages. There's a lot of inconsistencies. So, for instance, nuclear energy is demonized by some of the climate defenders, but there's other people out there, Bill Gates, and in the Netherlands, we're seeing that there's a clear movement backing nuclear energy because nuclear energy is absolutely essential if we are going to actually reduce emissions. And then coal. Yes, coal pollutes, yes, and in some parts of the world it's demonizing and they will do away with it. But we have to remember, as we heard in the presentation, in Asia, they're building coal plants right now because, as it turns out, this is very cheap energy, this is very abundant, this is very safe, it gives baseload, not intermittent, and with renewables, this is a very important issue. There's 1 billion people in the world who don't have access to electricity. And who are we to say you don't have the right to electricity? So there's different versions. Copper. Of course, copper mining is dirty. But if you want to electrify the world, you need huge, huge amounts of copper. So ESG, it's not crystal clear. And we don't just say, oh, this is good, oh, this is bad, and just happy-go-lightly jump into a decision. No, we carefully track. Okay, we change now and on to teams and process. A question about transparency and accountability. We're asked to be transparent. So what would you say? Well, I would say that I've been working with Fernando ever since 97, I think, in Germany. I think Fernando has virtues that I am lacking in. Fernando has become a specialist in some verticals, cyclical, for instance, and I have specialized in other fields. And then I think that, this is pertinent with regards our investments, is that we have made the same mistakes. So it's good, when you think about an investment, you say, oh, this happened 12 years ago. Oh, remember 15 years ago. Things happen. That's an example. And in professional terms, that would be it. And then from a personal point of view, I'm a godfather to one of his children, so what can I say? I think that this is very telling of the personal relationship we have, yes. And Alvaro, what can I say? I admire him tremendously, and I think that we work together beautifully. We understand each other. We, of course, have differences of opinion sometimes. We've been working together for a long time, so often we think alike. So I think we're complementary, yes. And the question that has to do with the team also, after 5 years investing in commodities, you hired, for the first time ever, an analyst in the field. So what is the relationship with the team like? Analysts, Michael, and so on?
Excellent question. Yes, we included in our team one of the commodities analysts, which has the best ranking. I think he's ranked #1 in the world. But it was quite peculiar because we've known this person for some time. We were his clients, and when he came to Madrid to meet with clients, he had dinner with us. And a time came in his life where after years in the British Treasury and then the sell side, he wanted to become a manager. And, well, he thought that Ad Valor, because of our portfolio and long-term philosophy, well, not your philosophy, because you put in the patience. We can do this thanks to the fact that people like you trust us. So we said, well, when somebody good comes along, we try to make him stay with us. We try to buy him, and he knows much more than we do on commodities. We told him that our challenge was that we were generalists and we wanted generalist analysts, and that in a couple of years or 3 years, he would also become a generalist investor. Michael has a different profile. He's in London, and he can do several things at the same time. And he looks under the different stones, and that's very useful always. And then our analyst team, we have the 2 senior people who joined us last year, who have reached cruising speed, and then other people who are also very good, and the relationship is very good with all of them. A question on the management and valuation models. When are you going to update and use machine learning in decision making? Well, we think that there is an aspect of this business that can be industrialized, and there we have the indexed funds that allow you to manage more amounts, etc. But we still think that there is room for a eye surgeon, and in that regard, machine learning and so on is something that we are a bit skeptical about. It's like somebody with a hammer who everything he sees for him is a nail. Well, we have tons and tons of information, and I'm not sure whether we know how to process that. Of course, machines can help to process, but humans will always be necessary. If you have to evacuate an area because there is because of the coronavirus, well, perhaps we don't agree with the man-made or the machine-made decision. I don't know. You always need the human factor. A question on liquidity. How would it affect us if we had reimbursements? How would we position the portfolio in terms of the market cap of companies and liquidity to provide more reimbursements? Do we have more liquid assets? Yes, the black swan of this business is having reimbursements and no liquidity to sell them. We had in 2018, well, in the previous one where we had 5 million in 2 weeks, but on this occasion, since what is cheap is what is cheap, which are commodity companies, uranium, copper, it is the most liquid portfolio that we've ever had in our history. 73% of our portfolio can be liquidated in a couple of days. We've never had such a liquid portfolio because there is no premium for liquidity. You can buy as many shares as you want of a company perhaps with 300 million euros in volume. They're listed at 9, and we think they're worth 32. You can buy all the Schlumberger shares that you want. It's the most liquid portfolio we've had. It's a very good question. Great. A question on fees, fund fees. There are several, but let me summarize them. Have you thought of rewarding the most loyal customers with lower fees? Well, it's something we hear a lot of late. We expected this question, being honest, because we've seen that the market is, well, doing things in this regard. And we've seen some entry flows in passive management with increasingly lower prices, which is only logical because there's an algorithm behind it. There's a machine behind it. Prices must fall. But we believe that in order to generate extraordinary returns, two things have to happen. It sounds simple, but you need to go against the grain and to go against the flow and be right. Number two, systematically in the world of public equities to go against the flow and be right. I don't think that is going to lower the fees. At the level of the aggregate market, that is not going to happen. I do think that they might evolve towards a lower fixed fee and a higher variable fee, perhaps. But I don't think they will fall. It sounds strange to us because if we get an extraordinary return, nobody minds about paying a fee, as they didn't mind in the previous phase. But if we don't get that extraordinary return, and those who have to judge when and how we've done it or haven't and in what time period, we need to accept it. And in that case, if we haven't obtained that return, it's no consolation for you to know that you pay lower fees. Now, having said that, we would like to do something for our clients who truly believe in this and are with us for 10 years. And there are some of them, and I see some faces of people who've been with us for 15 years. When they invest, when things fall, they don't do anything. When they go up, they invest more. We would like to do something for them. And I'm not just saying it. We've been working on this. It is not impossible, but it isn't easy either. Yes, we thought of using classes of shares in the fund where some participants can participate based on their seniority in the fund, of how long they have been invested in the fund. We're looking into it. There's another question which says exactly the same thing. Should we give incentives to long-term investments and therefore investors with that profile? But this is for Sergio. Why don't we lower the entry amount of the fund in exchange for permanence and penalizing exiting the fund? Well, penalizing permanence for a UCITS fund has its limitations. You cannot set a lockup of more than a year. And the reimbursement fee that will last longer of a higher percentage, it was 40,000 euros to start off with, and with the idea that we could try out the operational platform. Then we brought that down to 5,000. And then we decided that for investors under 23 years of age, it would be 500. And now the additional contributions have been lowered to 100 euros to make it easier for recurrent contributions or additional contributions of investors to the fund. Well, we thought 5,000 euros was a reasonable amount as a first investment, and then 500 euros for younger investors, but we cannot discard it, and we can look into it. Yes, why not? 3 last questions. Are you thinking of taking out a monetary fund where, apart from with increases, where the potential is lower, and that might be an alternative to reimbursement? We have the Ad Valor Capital Fund, and we can do very little more. We like that notion of excellence in everything that we do. And monetary fund, for us, it would be very difficult to add value to such a fund. No, today it's very difficult because all sovereign bonds, including short-term, of countries with top ratings are giving negative returns. So it's not an investment that is worthwhile. Just to clarify, the Ath Capital, 90% of it is short-term fixed income investments, and the rest of it are portfolios in the equity portfolio. Now, an investor says in 2016 we were not gurus of the stock exchange, and we're not experts now either. We encourage you continue with following your convictions. My question is, what is the best lesson that you've learned in 2020 so far? 2020. Well, you can extend that. Every day you learn a lesson, new things. After 25 years, great lessons. Well, unfortunately, well, there isn't anything that I can say this has changed my life, but of course you learn every day. Frankly, I didn't think that oil prices could reach $30. I don't know, what you can get out of that lesson, but from time to time you are surprised. I think that, I don't know if this is a lesson, but what concerns me the most is a certain coordination between central banks that have a lot of power and a huge impact. They have not been elected by citizens, so they're in an area where nobody can really tell them anything, and the impact they may have. I follow that with a great deal of attention, but I don't want this to sound arrogant on my part. On the contrary, being very humble, where you're not getting the historical returns, but that is normal and it has happened in the past. More than a time to change paradigms, it is a moment to have 2 very clear ideas. The best companies in the history, when they're expensive, they collapse, and cheap in the following decade, or when the time comes to get an interesting price level in the following decade, they're very good assets. This is the time to reinforce those convictions and say our portfolio cannot last for very long at a fraction of what Standard & Poor's is listed at. Well, what I said earlier, the most important lesson, I think, is in the tension between diversification and concentration. We pivoted a bit. So the advantages of diversification, having a well-diversified portfolio, is an exercise of humbleness. You might have convictions, but Not all investments have a risk, and at the end, you need to limit yourself constantly. We've always done that because we follow a process. We try to be very methodical. But even in that, we continue to learn, and we try to improve our processes little by little and the limits that we set to our own conclusions. And lastly, a personal question for each one of you. Can you sleep well at night? Well, if I'm very honest, this is a time of my life because they say that from 40 or 50 you have responsibilities with your children, you have responsibilities in the middle, which is your work, and then at the top too with your parents. So you have responsibilities at all levels. My mother died September 23rd of last year. My father is ill, and so I have responsibilities at the bottom, middle, and top at all these three levels. I am a believer, I'm a Christian, and I find consolation in my religion, but the people close to me, I see are suffering, many of them are suffering, and that keeps me awake some nights when I see people I love suffering. How about you? I have restless nights because of the stress from the concern that you see among co-investors and friends, family. It's not that, there's a gap between them and we, but we think that we're doing the right thing. We think it's the best portfolio we can have, but I am concerned that people might make the right decisions, the wrong decisions. That does sometimes worry me. Okay, thank you very much for coming today. This is a very special day. For me, it was difficult to come to. Thank you for your patience, and we hope to see you next year with better results.